Never, ever, 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 ever hold US stocks inside of your TFSA. That is what you're being told over and over. It's a tax trap, right? Well, for a lot of you, following that rule, it will actually cost you more money than just paying that tax itself. And today I'm going to break down the 15% withholding tax in a TFSA and why that attitude of never do it is often hurting you more than it's helping. Now, I'm not going to treat this as a yes or no question. I'm going to frame it more properly. I'm going to look at both sides of the issue. First, I'm going to walk through 3 reasons why the don't hold US stocks in a TFSA rule are actually valid and worth understanding. Then I'm going to explain 4 reasons why that rule isn't absolute and why in a lot of real world cases, because that's what we're dealing with here, holding US investments in a TFSA can actually still make sense. I want us to take an honest look at the trade-offs. Let's start with why this rule exists in the first place. The first reason the rule is valid is that the 15% withholding tax is unrecoverable in a TFSA. When a U.S. company pays a dividend, the U.S. government is going to withhold 15% of that before the money ever reaches you. That's part of the Canada-U.S. tax treaty. It happens automatically. Now, in some accounts, the tax is not a permanent loss. For example, in a taxable account, you can usually claim a foreign tax credit. In an RRSP, qualifying U.S. dividends aren't subject to withholding tax at all because the U.S. recognizes RRSPs as retirement accounts. But in a TFSA, you don't get that same treatment. From a U.S. perspective, it's just good old-fashioned regular investment income, and that means that the withholding tax will still apply. There's no way that you can recover it later. Once it's gone, it's gone. So that fact alone, which is true, is enough to make a lot of people cautious. I say that's a reasonable thing to think about. Now, the second reason that the rule is valid is that it creates a structural drag for income-focused strategies. And that's critical here. If your portfolio relies on dividends for cash flow, whether that is from US stocks, from REITs, from income-focused ETFs, then that 15% withholding tax does actually come straight off the top. And over time, that drag that you'll feel in the portfolio will compound. That reduces the income that you can reinvest. It lowers the effective yield of your portfolio. So if you are an investor who prioritizes income, so you're thinking especially here retirees, people who are close to retirement, this can have a more direct impact on your outcome. So I say yes, it is a valid concern. Now, the third reason that you might argue this is a valid rule is good old RRSPs. They already solve the problem. From a tax efficiency standpoint, U.S. dividend-paying investments are almost perfectly suited for RRSPs. We have that treaty exemption, which eliminates withholding tax entirely. And yes, RRSP withdrawals are taxable later on, but that's a separate decision more tied to your overall retirement strategy than looking at it purely from an investment standpoint here. So if you're an investor with enough RRSP room, if you place U.S. dividend payers inside there instead of a TFSA, that is usually a really good choice. But there's something that catches a lot of people off guard. To actually get that 0% in an RRSP, you have to hold the US listed version of the stock or of the ETF. As an example, I'm going to use 2 Vanguard funds, VFV and VOO. These are basically the exact same fund. They both track the S&P 500. But inside the RRSP, VOO is a better version, at least from a withholding tax perspective. You can think of it this way. If you're buying a fund with Canadian dollars, like VFV, the IRS will take its 15% cut before the money ever gets across the border to you. It is somewhat of a hidden tax that you're not going to see on your statement. If you want to dodge that entirely, you do need to hold the US dollar version like VOO. And that's because it is listed in the States, so the IRS doesn't touch your dividends. They just leave them alone. You can imagine over 20 or 30 years, that difference can add up to a lot of money. Now, word of caution here. If you buy a US stock with Canadian cash, most of the brokerages you're going to deal with, they're going to charge you a currency conversion fee, 1.5%, 2%. That would be on average. So if you're looking at a fairly large ticket, I'm just going to say $10,000 as an example. That's $200. That's gone instantly from that conversion. If you're moving a large amount of cash, look into a technique called Norbert's Gambit. And I'm not going to cover that specifically in the video here today, but it is a method that lets you swap your Canadian dollars for US dollars. And often it can save hundreds or even thousands of dollars before you even place a trade. Now, I will put a link here for a video that I saw recently posted by the Canadian in a t-shirt. And this video explains exactly how this works in a way that makes it very easy to understand. Thank you, Adrian, for that awesome video. Okay, let's talk now about why the never, ever, ever buy a US stock in a TFSA is not a hard and fast rule. I want to walk you through 4 reasons why it can still be very reasonable. They all depend on your situation. The first reason to think again is that capital gains are not subject to withholding tax. That 15% tax we're talking about here, it applies only to dividends, not to price appreciation. So if you're holding US growth stocks or low yield broad market ETFs, the majority of your return will probably come from capital gains. Now, if a stock doesn't pay a dividend, there's nothing to withhold there. And even when dividends do exist, they're often a relatively small part of that total return. Now, the second reason is the actual dollar cost is often overstated. You're going to hear that a lot. Let's put some numbers on the issue here. Let's say you have a US ETF that yields 1.5%. That 15% withholding tax, that reduces the yield by about 0.225%. So on a $10,000 holding, that's $22.50 a year. Even if you look at $50,000, it's about $112.50. Now, I do recognize that it's not the perfect scenario, but if you look at a lot of investors, that cost is just a modest one relative to the benefits that you have when you look at the diversification. You get the opportunities for long-term growth, being how large and how important the US market is for most North American investors. Now, the third reason is about how the TFSA actually works in practice. Any gains that you earn in the TFSA are yours to keep. There's no future tax bills. There's no clawbacks. And that means that for investors with a long-term horizon, especially younger investors here, the TFSA, that's often the best place to hold assets with the most upside. If your only account is a TFSA, while eliminating some of the best investment opportunities on the entire globe because of that 15% dividend, that doesn't make a lot of sense to me. Even if those come with a small dividend tax drag along the way, the long-term benefit of that tax-free growth, I'd say, should easily outweigh it. Now, the fourth reason that this rule is not absolute is simplicity. A lot of people overcomplicate investing. You can see some crazy systems out there, some elaborate spreadsheets. We often hear about asset location, which is valid, but putting the exact right stock in exactly the right account to save every penny, that might be overcomplicating it for a lot of people. In the real world, complexity can get in the way of consistency. And I would argue if you spend too much time trying to perfectly optimize for a 15% withholding tax, you could end up with a very fragmented, very confusing portfolio, some US stocks in your RRSP, some Canadian stocks in your TFSA, maybe a US dollar side account. You get the idea. Those are just examples. But something as simple but as important as rebalancing, right, can turn into a real nightmare if you have accounts spread all over the place. Of course, the big danger there is that you might stop even trying. And that's where behavior takes over. That's where behavior is such a big issue. Sometimes, if you have a simple, boring portfolio, let's say 1 or 2 accounts, they're more likely to stay on track versus those who find things overwhelming. Even if you have a portfolio that is 99% tax efficient, but so complex that you stop managing it, that will usually underperform a suboptimal, I'm going to call it TFSA account from a tax perspective, that you actually stick with, let's say for 30 years or longer. I would argue sometimes paying a small, $20 a year is just the premium that you pay for more of a stress-free strategy. So how do we think about this overall? A couple of things. There isn't a right or wrong answer. I think it's more about your priorities. If your goal is maximizing your after-tax income, then U.S. dividend stocks, generally, yes, they do belong in RRSPs. If your portfolio is large and more income-focused, asset allocation has more of an impact there. However, if your goal is long-term growth, simplicity, global diversification, then holding U.S. exposure inside of a TFSA can be entirely reasonable. There is not a one-size-fits-all solution. So I say pick what works best for you and then move on with your life. Hopefully, this gives you a clearer understanding about what has become a very controversial issue. As always, your thoughts, your comments are welcome. You agree with me or you disagree, all comments are welcome. As always, I say thank you for watching. Look forward to seeing you in the next video.